Today we're diving straight into a financial analysis report titled AMD Down Today, Up Tomorrow. Rocket Why I'm Buying the Pullback.
Mhm.
In short, it argues the market is overlooking huge AI catalysts in AMD after a small dip, making it a prime buy-the-dip opportunity.
And it's really well researched. The data is timely.
It is. This is fundamentally strong material, the thesis is sharp, and I was genuinely impressed by how quickly it incorporates real-time news like the Vultr MI355X deployment.
That's the kind of speed that gets you noticed.
Right. It identifies a great technical setup and pairs it with these really powerful fundamental drivers. But, and this is the first big opportunity, it's all about how that sophistication is presented.
I agree. The analysis itself is deep, the conviction is clear. But the packaging, I think it risks becoming a liability.
A liability how?
Well, the highly personalized and promotional language risks undermining the institutional strength of the underlying analysis.
Okay.
Look, the data points you found, Vultr deploying the new chips, the specifics of ROCm7, this is highly sophisticated stuff. It belongs in a serious investment memo.
Yeah.
But the language around it, all the zealous phrasing like, why I'm buying, the emojis, it just subtly dilutes the perceived objectivity. It feels less like a rigorous assessment and more like, well, a personal blog.
I get that instinct. I mean, you can tell the author is excited by the research, which is great.
It is.
But for an analysis that's meant to move serious capital, that emotion needs to be, contained. You persuade with facts, not just excitement, right?
Exactly. Just imagine a portfolio manager at a big fund skimming this. They see a rocket emoji in the title and their brain immediately, almost subconsciously, just files it away as retail, you know?
Right.
It doesn't matter how good the data is after that point. You've already created a psychological barrier. We have to remove that.
That's a critical point. So how do we keep that urgency, that actionability that modern investors want, but still get that institutional credibility? Is there a risk of it becoming too sterile?
It's a calibration, not an excision. The suggestion is just to temper the language. Let the facts, the confirmed Vultr deal, the record Q3 revenue, let them do the heavy lifting.
Let the facts speak for themselves.
Yes. The goal is to position this as an authoritative, objective assessment of a market dislocation, not a personal trade journal.
Okay, so we're changing the frame. Let's get into some concrete examples of how to do that, starting with the very first thing people see, the title.
Absolutely. You have to reframe the title completely. Instead of AMD Down Today, Up Tomorrow, Rocket, Why I'm Buying the Pullback, you shift to something with pure analytical rigor.
Like what?
Something like Advanced Microdevices, Evaluating the AI Dislocation and Investment Entry Point. It just immediately signals serious due diligence.
And that refinement should cascade down through the rest of the language. So instead of 3 massive positive signals emerged,
You'd say something like, 3 key fundamental developments emerged that support upside potential. It's precise, it's authoritative.
it's confident without being over the top.
Exactly. And you carry that tone all the way to the conclusion. The verdict right now reads, verdict, strong buy on weakness.
Which is clear.
It's clear, but it's stronger and more professional if it's refined to investment recommendation, strong buy on weakness, initiating position at $215 support. It keeps the actionability, which is crucial, but adds that necessary institutional feel. That small shift just gives the whole report the gravitas it deserves.
That's a really powerful refinement. So, now that we've set the right tone, we have to stress test the argument itself. Let's pivot to the second area, which is about really bolstering the risk analysis.
Okay.
The current Down Today section does a pretty good job addressing the external pressures. It talks about the sector-wide pullback, technical resistance, that reflexive fear from the, quote, NVIDIA shadow.
Yeah, the author clearly gets why the market sold off. That part is well laid out. I wonder, though, if we've really considered the internal challenges.
What do you mean?
To elevate the robustness of the investment thesis, the report must include specific fundamental risks associated with AMD's own internal execution on its AI roadmap.
Ah, I see. As I read it, the whole thesis really rests on AMD executing perfectly.
Perfectly.
On the Vultr deployment, on the software push with ROCm 7. But the current bear case is all technical and macro. It's about external headwinds, not internal points of failure.
Exactly. A truly comprehensive analysis has to anticipate how those amazing catalysts could still fail or, just fall short of expectations.
Because that would fundamentally disappoint the market.
Of course, if you're going to argue for a massive 30% upside to the $280 to $300 range, you have to explicitly model the risks of not executing flawlessly.
So the weakness is that the current bear case doesn't actually challenge the bull case. It's like they're two separate arguments.
That's the core vulnerability. It's what sophisticated investors hunt for. Are you presenting a hope-based scenario, or have you really deeply stress-tested this thing?
Right.
So the suggestion is to introduce one or two specific, measurable risks tied to the company's ability to actually capitalize on these AI opportunities. It signals to a pro reader that you've meticulously thought through the known unknowns.
Okay, so let's focus on the catalysts themselves. Where could they stumble? The Vultra deal hinges on the MI355X GPU, so the hardware ramp-up feels like a huge variable.
It is. A partnership announcement is step one. Guaranteeing a smooth, rapid deployment at scale is step two, and that is notoriously difficult in advanced manufacturing.
So you add a risk factor there.
You have to. You add a risk factor addressing the complexities of the AI hardware supply chain. You could phrase it like risk of slow MI555X yield ramp or delayed integration into partner superclusters.
Potentially impacting data center revenue recognition timeline.
Yes, that is a specific, fundamental, and measurable execution risk.
And that's a critical distinction. Because if that ramp is delayed, the stock breaking 210 is no longer just a dip. It's a signal the market thinks that core promise is failing.
Absolutely. And then there's the software piece. The analysis calls ROCm7 a game changer, and I see why. It's their big shot at building a rival to CUDA.
But we can't forget how deeply entrenched NVIDIA's system is. That's the real challenge.
It's the core vulnerability. So, building on that, you have to introduce a point on the competitive moat, on the high switching costs.
So you'd say something like,
You stated clearly, something like, while ROCm 7 marks significant progress, the continued high switching costs and entrenched developer preference for NVIDIA's CUDA remain a material, short-term headwind.
that must be modeled into the expected timeline for market share gains.
Exactly. It acknowledges the positive step, but grounds it in brutal competitive reality.
And then tying these internal risks back to the trading plan is the final piece, right? The conclusion already cites technical breaks at 210 or 200.
Right, but we need to explicitly connect those technical breaks to a potential fundamental failure. We're suggesting that a break in support could signal the market is losing confidence in the Vultra execution or the ROCm ramp.
That linkage is powerful. The technical level then becomes a proxy for the market's assessment of their fundamental progress. It just elevates the whole thing.
It really does.
And that brings us to our third area of critique, which focuses more on flow and the structural significance of the financial data.
Okay.
The analysis provides strong financial metrics. Q3 revenue at a record $9.25 billion, up 36% year over year. Record free cash flow of $1.56 billion. It proves the pivot to AI is financially sound.
The numbers are a solid validation, for sure. But structurally, the report can make them work harder. The report should integrate the historical financial performance more explicitly with the forward-looking AI catalysts to demonstrate AMD's capacity to absorb the massive R&D spend required to compete.
Okay, so the financial reality check section is a little isolated right now.
It is. It feels like a validation of the past, not an active enabler of the future. The crucial link is missing. That $1.56 billion in free cash flow, that is the war chest that lets them challenge NVIDIA.
The fuel tank for the fight ahead.
Exactly. Look at NVIDIA's R&D budget. Competing in this AI arms race is unbelievably expensive. That FCF isn't just a good number for shareholders. It's proof they can actually afford to burn billions fighting NVIDIA in the R&D trenches for years.
So the weakness is that the report sees the cash flow, but it minimizes the connection between that cash and their ability to actually sustain this massive competitive push.
Right. So the suggestion is to elevate that discussion, explicitly link the data center growth and the FCF to their ability to fund future milestones, like scaling Vultr and continuing to pour money into ROCm7. It reinforces the long-term viability of the entire thesis.
You're treating FCF not just as a historical metric, but as strategic capital.
It shows they're financially positioned for the aggressive multi-year war ahead. It transforms the FCF number from something that's just nice to have to something absolutely vital.
Okay, let's talk about integrating this structurally. Instead of having it as a separate section, we fold the cash flow strength right into the up tomorrow, the catalyst section.
That's the most powerful place for it. If you create a sub-point right there, call it, I don't know, financial engine for growth, FCF validation.
And then state the strategic implication clearly.
State it very clearly. Record FCF and robust data center revenue provide the necessary capital buffer and financial credibility to ensure sustained, aggressive R&D investment, mitigating the risk of being outspent by rivals.
That integration is so much more convincing. It connects today's financial stability directly to tomorrow's investment success. And thinking about it, we should probably pull that into the executive summary too.
A simple but powerful edit right at the top, where the report says, divergence is why I am buying the pullback. Just tack on a short financial justification.
So it would become, divergence is why I am buying the pullback, validated by record free cash flow and proven data center segment growth.
Exactly. It strengthens the core premise right out of the gate. It gives the whole thesis immediate financial and strategic weight.
This has been a really deep and I